NCB is back in the news. They've just received almost $10 billion in equity capital from its parent company, NCB Financial Group. Why did the parent company give NCBJ nearly $10 billion? Like, what's going on? Please explain that to us.
So, Basel III is this magical thing we keep hearing about. So, people are wondering, why does it matter? So, in the case of NCBJ, they are going to, have to look at the reality of Basel III requiring a higher regulatory capital minimum, which in turn means that they'd have to raise the regulatory capital. So, in the case of how you calculate regulatory capital, it is your share capital, your retained earnings reserve, and your statutory reserve. Add those three up, you get regulatory capital. Then you have the risk-weighted assets. That's not a simple thing to calculate. That's a bit told to you by the company. Once you buy the regulatory capital by the actual risk assets, what you get is your capital adequacy. So under Basel III, basically that 10% is likely going to change to 12.5% or even higher. So as a result, NCBJ has to, increase its capital adequacy to ensure that it's not too close to the minimum that will be applicable under Basel III. So at the end of March, we're 13.29%, and with this recent injection from its parent company, they're pushed up now to around 15% in terms of capital adequacy. First, I'm going to say, well, that's not much, but the fact that so much money, when you're using a 1% jump, kind of shows you how much or how large NCB really is for this context. And to be honest, NCBJ's capital injection kind of tells me, say, hey, this might be a reason for the APO. Because where would NCB Financial Group, the parent company, get that money in the first place to give NCBJ? Remember, they're a holding company. Or the management fees they get from NCBJ and the dividend income they get from NCBJ, Guardian, or other subsidiaries, they literally don't earn any other form of income, potential investment securities. So it's likely that, NCB Financial would have to take an additional debt recently to give NCBJ that actual, capital injection. Because over the last year, well, between September 2021 and September 2022, NCBFG's cash went down from $15.8 billion to $280.63 million. And that's quite a steep drop. So on the NCBFG side, there's something called double leverage ratio, and best practice and standard is that shouldn't pass 120%. What that means is the equity of the holding company divided by the equity of the subsidiaries divided by the equity in the parent company should not pass 120%. If it does pass 120%, then you have a problem. And that's where the BOJ would say, hey, you have to adjust this or deal with it.
So do you have an idea what this would make that ratio?
That's just it. I don't know, because at the end of December 2022, it was at 120%.
Oh. That's if indeed. So we're assuming that it's debt based on what you explained, but they would have to disclose this in their next financial statements anyway, right? So we soon find out.
Well, the quarterly reports, the disclosures are not as appropriate, but if you're reading the audited numbers which come out in December, then you're going to actually see these details in the notes. So, go ahead, Kalila.
No, I'm listening. I'm listening very keenly.
So, what people need to remember is that if NCBJ takes on, in this case, equity capital, what it does is that it increases the equity of the holding company, and that in turn reduces the double leverage ratio and brings it down. Because remember, the devil is taking $10 billion given to NCBJ. So that means that NCBJ, which is its equity would go up, while equity in the holding company would have remained the same. So by doing an APO, they could reduce the debt, and on top of that, increase the equity in the holding company, which in turn brings them down on the double leverage ratio. And this is just to show people that why they're saying NCB Financial Group made $40 million net profit last year and this and that. The reality is, if you don't try flowing through the holding companies, you're going to get lost by looking at the consolidated numbers. Let me explain it again. NCB Financial Group's consolidated numbers shows the economic activity of all the businesses in the NCB Financial Group minus any intercompany transactions. So when you say here $40 billion, that's representing all the activities that would have happened within the group. The $28 billion in profit attributable to shareholders represents what is attributable to NCBFG shareholders in particular. And although you're seeing such a large figure, not all of that income can actually flow up to the parent company. So remember, NCB Financial Group has 4 key subsidiaries. NCBJ, the Jamaican bank, as a wholly owned subsidiary. Clarion Group, which they own 50.1% of. They own 61.77% of Guardian Holdings and 100% of TFOB Limited, which is basically Link. When you actually check it out and look at the company financials for NCBFG, keyword company, not the consolidated numbers, you see where dividend income had a significant drop, during 2022. So in 2021, they got $14.97 billion in dividend income, and that all came from NCBJ. In 2022, they only got $1.23 billion in dividend income. So you can see if the dividend income from subsidiaries are going up, how can you pay dividends to shareholders? And this is just, showing, I'm giving a very simplistic overlay of how cash is moving through the financial group. And a major issue that people don't seem to realize is that while Guardian is a great business, their dividend is being paid in the wrong currency. What do I mean by that?
The TT dollars?
Yeah, that's a big issue. Because NCBFG doesn't directly own the Guardian shares immediately. They have an intermediary subsidiary called NCB Global Holdings Limited, which is based in Trinidad and Tobago. And whatever NCB Global Holdings gets, they then remit to the parent company once it can actually, be paid out as dividend income to come to the Jamaica bank account.
And I just saw an article out of Trinidad saying that one of their major banks, I don't remember which one.
Republic.
They're now reducing the amount that you can spend on your credit card in US dollars. Like they cut it in half.
From 10 grand to 55,000 US.
Yeah, exactly. So that just goes to show the issues that Trinidad has with that foreign exchange issue, which is playing out in this whole NCB saga as well.
Because the funny thing is,
go ahead.
So even PriceSmart, the one that sells and import more on Radials Road, they had $1 million worth of US dollar worth of expenses associated just to get USD out of Trinidad and Tobago, and that just for the quarter that ended recently. They spent more than $3 million US alone getting money out of Trinidad for the last 9 months.
Wow.
How did they achieve that? They bought euros and Canadian dollars and then sold them in to get US dollars. And what they'd also done is, export the goods to other countries or other member territories, for example, Jamaica, and then, take those US dollars, take for their liabilities. Because if you try to cash out NCB Financial Group, for one, Clarion Group has paid their dividends to date since they acquired in 2016. TFOB Limited, which is Link, has gotten $2 billion worth of equity to, start operations and grow. Guardian Holdings is paying dividends, but whereas in 2020, they got 95% of whatever Guardian paid out into their Jamaican bank account. They only got 2% back in 2022. I don't know what it is in 2023.
So coming back to the APO, and sorry, the NCB issue and this $10 billion capital injection from the parent company, this could explain why they're doing an APO at this time. Basically confirms what we've been suspecting on the show for the past several weeks.
Exactly, and the thing is, this is where going on the BOJ, the Bank of Jamaica's website, comes in handy. So they publish their balance sheets of the commercial banks, the merchant banks, and the building societies every quarter. And when you compare the balances for share capital between March and June, that's where you see that difference showing up, for NCBJ, and their parent company is NCB Financial Group. So that's how you understand that NCBFG gave NCBJ, the bank, $10 billion in equity. And you've seen it even with JN Bank. They got $7 billion worth of equity from their parent company, JN Financial Group, in the most recent financial year for them. And JMB Bank got $1 billion from their parent company as well. So you're seeing, the parent companies having to inject more equity capital into the subsidiaries. But at the same time, those parent companies be careful because they don't want to pass the 120%, in a sense, cap or marker for double leverage ratio. But with respect to the APO, persons are saying, why didn't do a rights issue? Why didn't they take on preference shares, for example? So there are different forms or ways, of how you can issue preference shares. The ones that were most commonly associated with what we know is the cumulative redeemable preference shares. So, for example, JMB Group Limited preference shares, LP preference shares, one preference shares. But the thing about those preference shares is that those are liabilities. Those don't go directly towards equity unless you meet certain conditions. And the thing is, if you're going to say, why didn't the rights issue? The reality is they're going to need to look towards, several potential investors to support the size and quantum of this offer, and to go through the mechanisms of, making offer available to other parties and other situations might not be worth the time. So that's why APO street and allow persons to buy in is a straightforward and more simpler way for them to get the equity capital, reduce the leverage ratio, and pay down debt as well. So NCBFG, the company, they have about $81 million worth of debt, in 2022, and about $60 million was due between last year September and this year September. They refinanced some recently, but there's more debt coming due next year as well, and in the form of bullet payments, meaning if they borrowed $1 billion in 2017, they'd only pay interest payments from then to today, and on the maturity in 2023, they pay all of the principal, this meaning the $1 billion back at one time. And this is just, where sitting down and going through the financial statements in detail of, holding companies, kind of shows you how money flows within financial groups and how dividends can be paid as well.
So before we bring in Keisha, Roswell has a great question here for you, David. She says, Basel III, Basel II credit rating, I understand. Question, how long can companies stand up strong if we should have a deep economic downturn in the future because their dependent is loan, etc.? I get the gist of what she's asking.
To be honest, Kalila, there was a layoff, at a broker last week, and I'm hearing, of other potential layoffs coming in the financial sector in the coming months. So for some persons, they're going to have a very rough Christmas because right now in this very difficult economic environment, people are taking the most judicious decisions of how they should move forward considering all that is going on. So longer this string continues to go on, in a sense, the harder it is going to be, not just for banks, but other financial institutions.
Wow. I can tell you for a fact right now, it is a tough economic environment. Businesses are having a hard time. Many businesses, let me not say all, because they're always the outliers that are able to find a way and take advantage of, whatever is going on.